VIP John AG here. $8 trillion. Gone. Not in a day. Not in an hour. In 45 minutes. That is not a typo. That is not hyperbole. That is the documented market cap destruction that ripped through global equities and commodities in a single coordinated window. And I'm about to reconstruct it for you minute by minute, position by position, institution by institution. Because what happened was not a correction. It was not profit-taking. It was not normal market behavior. It was a surgical strike, and the mainstream financial media has barely whispered a word about it. Silver dropped over 3% in that window. Gold lost nearly 2%. The S&P shed hundreds of billions in market cap. And while retail investors were scrambling to figure out what happened, the institutions that triggered this chaos were already repositioning for the next move. If you have been watching this channel, you already knew something like this was coming. I told you in the previous video that the setup was there, that the open interest structure on COMEX was a loaded weapon. Well, that weapon just fired. And today I am going to show you exactly who pulled the trigger. Let me set the stage with the numbers as they stand right now. Silver is sitting around $32.40 on the spot market as I record this. Gold is hovering near $3,220 per ounce. Those numbers sound relatively healthy on the surface, but they are misleading if you do not understand what happened in the hours before they stabilized. Silver was trading above $33.60 before the attack began. Gold was pushing past $3,280. Both metals were showing strong momentum, building on weeks of steady accumulation by both retail and institutional buyers. Physical demand from mints and dealers was robust. Shanghai premiums on silver were running between $1.50 and $2 per ounce above COMEX spot, which is a massive premium by historical standards. Everything was pointing toward a breakout, and that is precisely why the attack happened. Here is how it unfolded. The first signal came from the futures market, specifically the COMEX June silver contract and the August gold contract. In the span of roughly 10 minutes, an enormous volume of sell orders hit the bid side of the order book. I am talking about over 15,000 silver contracts dumped in rapid succession. Each contract represents 5,000 ounces. That is 75 million ounces of paper silver sold in minutes. Let me say that again. 75 million ounces of paper silver. Global annual mine production is roughly 830 million ounces. So roughly 9% of annual global production was sold in paper form in a 10-minute window. That is not a trader taking profits. That is a coordinated liquidation event designed to do one thing and one thing only: smash the price through critical support levels. The gold market saw a similar pattern. Approximately 22,000 gold contracts were sold in a compressed time frame, representing over 2.2 million ounces of paper gold. The combined notional value of these sell orders across both metals exceeded $14 billion. And this was just the metals complex. Simultaneously, S&P 500 futures saw a cascade of sell pressure that triggered algorithmic selling across global equity markets. European indices dropped. Asian futures followed. Crypto took a hit with Bitcoin pulling back from around $104,000 to briefly touching below $101,000 before recovering. The total market cap destruction across all asset classes in that 45-minute window reached roughly $8 trillion. This was not a coincidence. This was not organic. Now let me walk you through who was on the other side of these trades. COMEX publishes commitments of traders' data, and while the most recent report has a lag, the positioning tells a clear story. The commercial category, which is dominated by bullion banks like JP Morgan, HSBC, and Bank of Nova Scotia, had been building a historically large net short position in silver over the prior 2 weeks. At last count, the commercials held a net short position exceeding 62,000 contracts. That is over 310 million ounces of silver shorted by the banks. On the other side, the managed money category, which includes hedge funds and commodity trading advisors, had built a massive net long position. They were long roughly 48,000 contracts. This is the classic setup. The banks build shorts against the speculative longs, and then they engineer a price decline that forces the longs to liquidate. The stops get triggered. Margin calls go out. Forced selling accelerates the decline, and the banks cover their shorts at lower prices, pocketing the difference. It is a pattern that has repeated dozens of times in the precious metals market, and it is documented in the data for anyone who cares to look. But here is what made this particular attack different. The timing was not random. It happened during a window of low liquidity, specifically during the overlap between the Asian close and the European pre-market. This is the thinnest part of the trading day for metals, when the order book has the least depth. A large sell order in this window has an outsized impact on price because there are simply fewer buy orders to absorb the selling. This is not speculation. Market microstructure studies have shown this repeatedly. The choice of timing was deliberate. It maximized the price damage per contract sold. And let me be crystal clear, this is not financial advice, and I am not alleging anything illegal. I am pointing to publicly available data and drawing the connections that CNBC will not draw for you. The broader macro backdrop made this attack even more effective. The Federal Reserve had just released minutes from its most recent meeting suggesting that rate cuts might be pushed further out than markets expected. The dollar index spiked to around 104.6 on the news. Treasury yields moved higher, with the 10-year pushing above 4.5%. In a normal environment, this creates a headwind for gold and silver because higher yields increase the opportunity cost of holding non-yielding assets. So the attackers had the perfect cover story. They could dump futures, crash the price, and the financial media would simply explain it away as a rational response to higher yields and a stronger dollar. And that is exactly what happened. Every mainstream outlet ran the same headline: gold and silver fall on Fed hawkishness. Nobody mentioned the concentrated selling. Nobody mentioned the timing. Nobody mentioned the open interest structure. Because that narrative does not serve the interests of the institutions that advertise on those networks. Looking at the numbers, about 75% of you watching right now are not subscribed. If this kind of unfiltered forensic analysis is cutting through the noise and giving you clarity that you are not finding anywhere else, hit that subscribe button. That is how we grow a community built on truth and data, not hype and clickbait. Drop VIP John AG in the comments so I know you are part of the team. If it is not for you, no hard feelings. I do not chase empty metrics. I do not sell signals. I do not sell mentorships. I do not sell courses. I just do this work because the OGs in this community deserve someone who respects their intelligence enough to show them the actual data. Now here is where it gets truly insane. Here is the smoking gun that nobody is discussing. While the paper price of silver was being demolished on COMEX, something extraordinary was happening on the Shanghai Futures Exchange and the Shanghai Gold Exchange. The premium for physical silver delivery in Shanghai did not collapse with the COMEX price. It actually widened. During the attack window, the Shanghai silver premium expanded to over $2.30 per ounce, above the COMEX spot price. Let me put that in perspective. The historical average premium is around 20 to 40 cents. A premium of $2.30 means that real buyers in the world's largest physical consumption market were willing to pay a massive markup to secure actual metal, even as the paper price was being slaughtered. If the price decline were driven by genuine fundamental weakness, if real demand were actually falling, the Shanghai premium would contract or go negative. Instead, it did the opposite. It screamed higher. This is the single most important data point from the entire event, and not one major financial outlet reported it. And here is the second piece of the smoking gun. COMEX registered silver inventory, the silver that is actually available for delivery against futures contracts, has been declining steadily. As of the most recent report, registered silver stood at approximately 78 million ounces. That number has dropped from over 150 million ounces just a couple of years ago. Eligible inventory, which is silver stored in COMEX vaults but not available for delivery, sits around 215 million ounces. But eligible does not mean available. That metal belongs to specific entities, and there is no guarantee it will ever be converted to registered. So when the banks dumped 75 million ounces of paper silver in 10 minutes, they sold almost the entire registered inventory of COMEX in synthetic form. They sold silver that, for all practical purposes, does not exist in sufficient quantity to deliver. And this is the fundamental fraud of the paper market. It allows the creation of virtually unlimited synthetic supply to suppress the price of a commodity that is physically scarce. The ratio of paper silver to physical silver available for delivery on COMEX is now estimated to be in the range of 300 to 1. 300 ounces of paper claims for every 1 ounce of real metal. That is not a market. That is a fiction. Let me contrast this further. Physical silver demand on the retail side has been nothing short of explosive. Major online dealers in the United States are reporting shipping delays of 5 to 12 business days on popular products like American Silver Eagles, Canadian Maple Leafs, and 10-ounce bars. Premiums over spot for Silver Eagles remain elevated at around $5 to $7 per coin. The United States Mint has been unable to keep up with demand for months. The Royal Canadian Mint has increased production but is still falling short. The Perth Mint in Australia reported a significant jump in silver sales in its most recent monthly data. India, which has been a massive silver buyer this year, imported over 4,000 metric tons in the first 4 months of the year alone. That is a pace that would exceed last year's record imports. Industrial demand continues to surge, with the solar panel industry alone projected to consume over 230 million ounces of silver this year, up from around 180 million ounces just 2 years ago. Electric vehicle production is adding millions of ounces of demand annually. AI data centers require enormous amounts of silver for their electrical contacts and thermal management systems. And defense applications, particularly in advanced missile systems and satellite technology, are consuming silver at increasing rates. This is the physical reality. And yet the paper price says silver is worth $32.40. The disconnect between the physical market and the paper market has never been wider, and it is widening by the week. Now let me address the bearish case head-on because balance matters, and I refuse to be a one-sided hype channel. The risks here are real. First, margin hikes. The CME Group, which operates COMEX, has the ability to raise margin requirements on silver and gold futures at any time. They have done this before at critical moments, notably during the 2011 silver run toward $50 and during the 2021 silver squeeze movement. Higher margins force smaller speculators to either deposit more capital or liquidate their positions. This creates additional selling pressure and can accelerate declines. If silver pushes higher from here, I would consider it almost certain that margins will be raised. Second, the dollar could strengthen further. If the Fed maintains its hawkish posture and global economic weakness drives capital into the dollar as a safe haven, metals could face sustained headwinds. A dollar index above 106 would create real technical damage for gold and silver. Third, a deflationary shock is possible. If global trade disputes escalate further, with new tariffs and counter-tariffs disrupting supply chains, we could see an initial deflationary impulse where everything sells off, including precious metals, as happened briefly in early 2020. Silver especially is vulnerable in this scenario because roughly 50% of its demand is industrial. A global recession would reduce industrial consumption and could pressure prices lower even as investment demand increases. Fourth, there is the simple reality that concentrated short-term selling can push prices far below fair value for extended periods. The banks have deeper pockets than retail traders, and they can maintain short positions longer than most longs can maintain their margin. This is not a game of fairness, it is a game of financial endurance. But here is the bullish case, and it is built on bedrock. J.P. Morgan Chase, the same institution that has paid hundreds of millions in fines for spoofing the precious metals market, has accumulated one of the largest physical silver positions in recorded history. Estimates range from 500 million to over 700 million ounces. Let that sink in. They manipulate the paper price lower with one hand while accumulating physical metal with the other. They are not doing this for fun. They are positioning for a revaluation event that they know is coming. Central bank gold purchases have been running at record levels. The People's Bank of China has been adding gold reserves consistently and is now among the world's top holders. Russia, India, Turkey, Poland, and multiple other nations are building gold reserves at a pace not seen in decades. These central banks are not buying gold because they think it is going lower. They are buying because they understand that the current monetary system is approaching a structural reset. The The BRICS nations are actively developing alternative payment systems and trade settlement mechanisms that reduce dependence on the US dollar. This is not conspiracy theory, this is publicly stated policy. The mining supply situation for silver is critical. Global silver mine production has been essentially flat for the past several years, hovering around 820 to 840 million ounces annually. Meanwhile, total demand, including industrial, investment, jewelry, and silverware, exceeded 1.2 billion ounces last year. That is a structural deficit of over 350 million ounces. The Silver Institute has documented this. Above-ground inventories are being drawn down to fill the gap. This is unsustainable. At some point, the physical market will overwhelm the paper market. The question is not if, but when. 3 key takeaways and we are out. 1. The 45-minute wipeout was not organic. The concentrated selling by commercials in a low liquidity window, the simultaneous pressure across multiple asset classes, and the widening Shanghai premium all point to a coordinated event designed to flush speculative longs and reset positioning. This is documented in the open interest data and the volume records. 2. The physical market is screaming a completely different story than the paper market. Shanghai premiums above $2, dealer delays, mint backlogs, record central bank purchases, and a structural supply deficit of over 350 million ounces annually tell you that real silver and real gold are in high demand. The paper price is a managed fiction that serves the interests of the institutions that control the futures markets. 3. The accumulation by entities like J.P. Morgan tells you everything you need to know about where they believe the price is going long term. They do not accumulate hundreds of millions of ounces of a commodity they expect to decline. They are front-running a repricing event, and every manufactured dip is an opportunity for them, and potentially for those paying attention, to add to positions at artificially suppressed prices. The unresolved tension is this. The paper market has maintained control for decades through unlimited synthetic supply creation and coordinated interventions. But the physical inventory drawdowns are accelerating. The industrial demand growth is structural and irreversible, and the geopolitical shift away from dollar hegemony is gaining momentum. What happens when the last ounce of registered silver is claimed from COMEX vaults and the paper promises cannot be fulfilled? That is the question that keeps bullion bank risk managers awake at night. And it is the question that I will continue tracking in every video on this channel. As always, do your own due diligence. Understand the risks. Be accountable for your own decisions. Nothing in this video constitutes financial advice. I am sharing my analysis based on publicly available data, and you are responsible for your own investment choices. Invest with logic, not hype. VIP out.